Hello, traders, and welcome to Simpler Trading. I'm so glad you could join me today. My name's Melissa, and I'm a trader here at Simpler Trading. If you're not a part of the Simpler Trading community, I invite you to join us. Simpler trading is different than most services. And why I say that is we're a group of traders dedicated not only to giving you great trade alerts, but also in educating you to be a more consistent and disciplined trader. So, there will be a link in the description of this video that will give you all the information of how you can join us for only $7 for a 30-day trial. So let's get started. What I want to talk about today is 3 trading strategies that surprisingly work for beginners, and not just beginner traders, but also if you find yourself struggling to find an edge in the market. I'm going to spend about the next 20 minutes or so going over these 3 strategies. I know we have big economic data coming out today with FOMC uh, minutes. And then also, of course, Jerome Powell will be speaking. And I want you away from this live session in enough time to trade that event if you want to do so. All right, I'm going to remove my face here as we go through these 3 strategies that work surprisingly well, and then I'll come back on at the end. Did you know that 90% of new options traders quit in under a year? Seriously, think about that for a second. The other 10%, most of them aren't some kind of option gurus with secret knowledge of the Greeks or a crystal ball for volatility. Nope. They're usually just repeating the same 3 moves on the same handful of tickers, setups so simple a high schooler could copy them. Today, you're getting those exact moves. No complex spreads, no $5,000 course to buy, and definitely no rocket emojis anywhere in sight. So, ready to cut through the noise? As I said, I'm Melissa, and yeah, I trade options on anything that moves: ETFs, big tech stocks, SPX, all things that have great liquidity. But it wasn't always like this for me. I spent a long time giving back more profits than I care to admit. My P&L graph looked like this one: big swings, up, down, up, down. And I got tired of it. The thing is, I was constantly giving back too many profits, feeling like I was chasing my tail. And then I finally had an epiphany. The pros aren't necessarily smarter than us. They just repeat the same boring, repeatable setups on liquid tickers. They figured out what works on SPY or QQQ, and they stick to it day in and day out. All right, so let's get rolling here with the 3 strategies that I want to share with you today. Strategy number 1 is what we call the lazy trend ride. Imagine a stock's price action is like a toddler on a trampoline. Once that little guy jumps in one direction, what usually happens next? They take another hop, right? In the same direction. Our job as option traders isn't to predict the absolute peak of their jump. No, our job is just to buy a cheap ticket for that second bounce. It's about recognizing existing momentum on a big liquid stock and riding it, not trying to be a market oracle. This strategy is all about keeping it simple and letting the markets do the heavy lifting. So, step 1 for this strategy, I want you to open a daily chart for a key ETF like SPY or a highly liquid stock like Apple. Seriously, pick just one and stick to that one ticker. Then I want you to add a 21-day simple moving average. Nothing fancy, no complex indicators, just a plain old 21 SMA. That's the white dotted line on this chart. Why the 21 SMA? Because it's widely respected indicator of a reversion to the mean in a stock that is trending, and institutions watch this level. It smooths out the daily noise and gives us a clear directional bias. Here's your filter, because filtering or knowing what the trend is so very, very important. The trend is our friend, and I want to be trading with that trend. So if the candles are consistently closing above the 21 SMA line, then we're only scouting for call options. If the candles are closing below that 21 SMA, then we scout for put options. No exceptions, no second guessing, no buying puts on a stock that's in a clear uptrend. This rule keeps you on the right side of the dominant trend, reducing your chances of getting run over. It's about aligning with the market's path of least resistance. And step 3 for this strategy is, after you have found that 21 SMA on the daily chart and you have established what the overall trend is, now I want you to drop that down to a 2-hour chart of that same ticker. This is where we're going to find our entry. We find the entry by patiently waiting for a pullback, price moving against the daily trend. Okay, you can see any pullback to this daily 21 SMA here represents a potential entry. When price pulls back and touches the 21 and the 21 holds as support, this is key. Then we want to buy a call option if we're in an uptrend, or a put option if we're in a downtrend. And as soon as a candle confidently closes above that 21 SMA, that, my friends, is the trigger to enter the trade. Now, take a look here. I showed you with these green check marks or the red X's some potential entries because there was a pullback to the 21 SMA. On this entry, it gets a valid signal to go long because the 21 touch held as support, and then we got a decisive move above that 21. On this example, price indeed came back to the 21, but notice there was no decisive move above the 21. That means because this stock is in a bullish trend, right? And I'm looking to buy calls, this was not a valid entry. Come over to the next touch of the 21, we actually flushed below it. There was no decisive move back above it, so this is not a valid entry for this strategy. And then the fourth time, we get the touch of the 21 with a decisive move above. That, my friends, is a valid entry, and you can see it would have paid very, very well. I'm going to give you a piece of advice here regarding an expiration date on trading this reversion to the 21 on a daily chart. I would choose an expiration date that is 30 to 45 days out to give the trade time to work and to reduce the impact of time decay. Now let's talk about step 4. Step 4 is all about setting your stop or managing your risk. This is non negotiable. Your stop loss is not on the option itself, but on the underlying stock price. I want you to place your stop loss on the chart just under the recent swing low for calls or above the swing high for puts. If the stock price closes beyond this price, you sell the option. No questions asked. Price of doing business. This caps your loss at an easy to define technical level. For your take profit, I like to aim on my first target for a greater than 1-to-1 risk to reward. And then I want my next target or my final target to be a 1-for-2 risk to reward. That 1-for-2 risk to reward ratio is crucial for you to have long term profitability. That's it. You're literally just riding the second bounce. Now, the win might not be yacht money, but it's about making consistent and repeatable gains. Now, I'm going to talk about the second strategy. We're going to call this one the coffee break breakout. So, this is more geared towards day traders. While most day traders are glued to 5-minute charts, stressing over every tick, sorry, some of the cleanest options trades happen in a very small window. The core idea is fascinating. Markets often get chaotic right after the opening bell, but then they tend to break out of the previous day's range or the pre market range and show their true direction. We're here to capture that second, more decisive move with a simple call or put option, meaning we're going to buy a call or buy a put. It's a quick, high probability setup on ETFs like SPY or QQQ or highly liquid names like Apple, Nvidia, Tesla. It gets you in and out before your latte even has a chance to cool. Here's a simple checklist that you can literally scribble on a napkin. First thing in the morning, I want you to note the previous day's high and low on a 5-minute chart for those liquid tickers such as SPY, QQQ, SPX, NDX, whatever it is you're choosing to focus on for your day trade. Then at precisely 9:45 a.m., okay? 9:45 a.m. I want you to have your alerts set. One is going to be at the high or the battle lines, right? Here's our battle lines, the high and the low. I want one alert set at the high and one alert set just below the low. Okay. When an alert goes off, and in this case, it would be an alert as price is above yesterday's high after the first 15 minutes of chaos. The alert goes off, price is at yesterday's high. That is a trigger, right, to buy calls. So as soon as that price or that alert goes off, you buy an at the money call option with the weekly expiration. So if I was trading this on Apple, I would be buying Friday's expiration. All right. Now, of course, we have to know our stops. In this strategy, the way that we choose our stop is like this. I want you to use Fibonacci from your high, or sorry, well, it don't matter which direction you go because we're choosing 50%. But from the low to the high, so your battle lines, draw your fibs there and mark the 50 retrace. Okay, that is going to be our stop on this trade. And again, the stop is based on the underlying stock price, not your option premium price. So if the stock reverses after you enter and closes on a 5-minute candle below that 50% retrace, then you're stopped out. It's not about reacting, it's about predicting. All right. So the stop loss is based on the underlying stock price. Again, I've already said that. Now, what's an easy way that you can figure your targets? Again, I like to use that greater than 1-to-1 risk to reward on my first target. And then I want my second target to be somewhere around the 1-to-2 risk to reward ratio, making my reward twice as much as my risk. So in this example, I have about $2 of risk. My first target to be better than 1-for-1 needs to be $2 or more above. I take that and I double it, which would be $4 to get that second target. Once price makes it to my first target and I have exited out of half of my position, then I put in a break even stop. That helps me to ensure that any winning trade does not turn into a losing trade. Can it be intense for 30 minutes to an hour? Yes. But beginners love it because the trading is typically done by 10:30 or so in the morning and you have the rest of your day to live your life not staring at the chart. So this is another cool strategy that works surprisingly well. Sorry, guys, I'm battling allergies. But let's talk about the third strategy. It's actually my favorite strategy and the one that I trade well over 80% of the time. It's the support and resistance coil. So, for our final strategy, we're going to act like a professional poker player. We're not playing every hand, we're waiting for a specific tell at a critical moment. In trading, this tell is often a period of indecision right at a major support or resistance level. We're looking for the market to coil up like a spring before it makes its next big move. This setup uses a powerful candle pattern called the inside candle. All right. And as you know, that's my favorite candlestick pattern. I use it to catch reversals or continuations from areas where big money is making decisions. So let's look at this setup step by step. Step one is finding support and resistance. It is not rocket science. Honestly, when you first look at it, it might look a little complicated, but it really isn't. What you're wanting to look for is that inside candle. So, a candle that closes inside the body of the previous candle. It's often a small candle. You will know that it is resistance if you have another candle come up, and in this case, resistance, right? You have another candle, this very next candle here came up, tested this area or this zone, and it rejected. Then I want you to find the support. We're going to use the same idea. We're looking for a candle that is an inside candle, a pause in the market before a move. Once you've located that, you draw a zone around it using the low and where that support or the top is where price is bouncing from. The bottom is where the low of the candlestick pattern. All right. You will know this is good support level if you have a test of it and then a rally off of it. On this example, we had a test here with a nice rally off of it. Then we had a test here with a small rally, a test here with a small rally, and finally a test here that gave us a better rally. So I have identified my support and my resistance. This is my trading arena for the support and resistance coil strategy. All right, let's now look at step 2. Once I have found that support and resistance level on a daily chart, if we're swing trading, if I'm day trading, I'm going to use a 2-hour chart to find that support and resistance. But for swing trading, I'm using the daily chart. So in this example, I have moved down now, this is step 2, to a smaller time frame, to a 4-hour or a 2-hour from that daily chart. Or if you're looking to swing trade and you found your support and resistance off of a 2-hour chart, then I would move down to a 5-minute chart or even a 3-minute chart. All right. We're going to wait patiently. This is the key. Wait patiently for price to return to one of these major levels. Okay? Once price returns to one of these major levels, I am waiting for confirmation that buyers are stepping in if it is a support level, or that sellers are stepping in if price is at a resistance level. Let's talk about my actual trigger in this example. I like to wait for a higher low inside of my zone, which would be right here. We made a low, the next candle made a higher low, and then we got a breakout candle. That is my trigger. If I were in resistance, I am waiting for a lower high followed by a breakdown candle. That is my trigger for a play buying puts to the downside. All right. All right. Now, of course, no trade plan is complete without knowing your stops and your targets. Risk management is built in to this strategy. For a call trade at support, your stop loss is placed just below the low of the formation. And for a put trade at resistance, it's just above the high of the formation. Your profit target should be the next major support or resistance level. That typically will give you a clean 1 to 2 risk to reward ratio. But like with any of my trades, I prefer to scale out at or greater than a 1 to 1. I sell half of my position at a 1 to 1 or greater profit target and then remain in the rest to final target. Again, if I'm swing trading from a daily chart, I'm choosing an expiration that's 30 to 45 days out to give me plenty of time. And if I am day trading, I am choosing a weekly expiration. This strategy requires patience as you might wait days for a swing trade setup, but when it appears, the signal is incredibly clear and the risk is well defined. That's why I like it. I've talked a lot about risk, and I got to mention before I end that risk is the most important part of trading. Here's the thing about all of these setups, and frankly, about any successful option strategy, they share one vital, often overlooked secret. You cap your absolute worst day. This isn't about winning every trade. It's about surviving a trade to, or sorry, surviving to trade another day. Under any circumstance, never risk more than you're comfortable with losing and that your overall account balance can handle on any single trade. Grab a sticky note, slap it on your screen. This single rule is your ultimate shield against blowing up your account. Now, you've all heard of Mark Douglas. Well, he teaches a very, very valuable lesson that everyone needs to hear, or you need it repeated for you to hear. All right. When putting these strategies to the test, I want you to pick one strategy that resonates most with you, then trade only that strategy for at least 30 days or 30 trades. Then I want you to journal everything, your entry, your stops, your targets, the result, of course, but also your emotions while you're in the trade and any rules that you might have broke. Then review these journals and correct any mistake that you might have made. At the end of the 30 trades, assess if that strategy is working for you. If not, I want you to repeat the same process for a different strategy. I know it sounds slow, but learning to be disciplined and consistent is a goal. Running around like a chicken chasing all kinds of strategies is a whole lot slower and far more painful. Believe me. Let's talk about narrowing your focus list. Look, the options world is a vast playground, but you don't need to play in every sandbox. Pick one playground and stay there. Will you trade options on broad market ETFs like SPY and QQQ, or focus on 5 to 10 high flying liquid tickers like Tesla and Nvidia that offer explosive moves but higher risk? Or maybe you're going to stick to trading only SPX. No arena is inherently easier. Choose the one that genuinely fits your risk tolerance and personality, and then commit to mastering it. Trying to trade options on everything usually makes you a master of none, but focus breeds expertise. Here's why these strategies work. These strategies aren't magic. They work precisely because they're simple enough to code into a single if then statement based on the underlying stock's price. This simplicity means your brain won't second guess things like delta, theta, or vega when you're tired or stressed. It removes the paralysis by analysis that plagues so many traders. At their core, they rely on the underlying asset's tendency for mean reversion or momentum. These aren't abstract concepts. They exist because human psychology drives buying and selling. Our option strategies are simply tools to capitalize on these predictable human behaviors in the underlying stock. Crucially, every single one of these strategies gives you an exit plan based on the stock's price before you ever buy the contract. There's no guessing, no hoping, just objective math. You know your maximum risk. I know the markets can feel incredibly rigged when you walk in without a clear set of rules, right? We've all been there. I've been there. I know that for sure. But today you're walking out with three powerful battle tested option strategy: the lazy trend ride, the coffee break breakout, and the support and resistance coils. These aren't just theoretical constructs. They work best in highly liquid ETFs and stocks. They need zero expensive indicators and definitely zero crystal balls. What they do need is for you to commit to doing the next 30 trades in a consistent way. Master that disciplined practice, and you'll finally swap the frantic casino mindset for a calm, methodical business one. So, I look forward to seeing you the next time I'm live. And again, if you're not a member of Simpler Trading or you're not a member of the Trendy Trading Room, where me and my trading partner, Trendy John, trade live every day, I invite you to join us. There will be a link in the description. I look forward to seeing you all in the next video. Have a great rest of your day.